For years, utility companies were considered the quiet corner of the stock market. They were steady, predictable, and often described as boring. Investors looked at them primarily for dividends and defensive exposure. They weren't associated with rapid growth, technological excitement, or bold transformation. In bull markets driven by innovation and expansion, utilities were rarely the stars. But in 2026, something unusual is happening. Utility companies are suddenly market darlings, and the reason has far less to do with hype and far more to do with structural shifts in the economy. The first major driver is the explosion in electricity demand. Over the past few years, energy consumption patterns have changed dramatically. Data centers are expanding at an unprecedented pace. Artificial intelligence infrastructure requires massive computing power. Advanced manufacturing facilities are being built domestically. Electric vehicles are increasing grid load. Electrification efforts across industries are accelerating. All of this translates into one simple reality: more electricity demand. For decades, electricity demand growth in the United States was relatively flat. Efficiency gains offset population and economic growth. Utilities operated in a slow-growth environment. But now, long-term demand projections are being revised upward. When a traditionally stable sector suddenly gains visible growth potential, investors take notice. The second reason utilities are attracting capital is predictability. In a market environment characterized by volatility, investors are gravitating toward companies with stable revenue models. Utilities operate under regulated frameworks. Their returns are often structured around approved rate bases. They generate recurring, predictable cash flow. That predictability is highly valuable when other sectors face demand swings, pricing uncertainty, or margin compression. Capital is flowing toward businesses that can provide clarity. Utilities, by design, offer that clarity. Their revenue is tied to essential services. Electricity and water are not discretionary purchases. That stability reduces downside risk. Another key factor is infrastructure investment. Governments and regulators are prioritizing grid modernization, renewable integration, and energy resilience. Large-scale investments are required to upgrade aging transmission systems, expand capacity, and integrate renewable energy sources. Utilities are at the center of that transformation. As billions of dollars flow into grid expansion and clean energy projects, utilities are positioned as primary beneficiaries. These investments expand regulated asset bases, which in turn support earnings growth over time. This creates a rare combination: infrastructure-backed growth with regulated returns. There is also a strategic national dimension. Energy reliability has become a critical issue. Extreme weather events, cybersecurity risks, and geopolitical tensions have highlighted the importance of resilient domestic infrastructure. Utility companies are no longer just service providers. They are strategic assets in national stability. That importance can translate into supportive policy frameworks, long-term planning visibility, and relatively protected market positions. Investors recognize that utilities sit at the intersection of economic growth, energy transition, and national resilience. Another reason utilities are gaining attention is their role in supporting AI and data center expansion. Technology companies building large data centers require stable, scalable energy supply. In many regions, grid capacity has become a bottleneck. Utility companies that can expand transmission and generation capacity are directly tied to the growth of the digital economy. In other words, utilities are indirectly benefiting from the AI boom. As hyperscale data centers multiply, utilities that can provide reliable, high-volume power become critical partners. Long-term power purchase agreements add revenue visibility. Capacity expansion projects increase regulated returns. This linkage between cutting-edge technology and traditional energy infrastructure is reshaping investor perception. Utilities are no longer seen as disconnected from innovation. They are enabling it. Interest rate dynamics also play a role. Utilities have historically been sensitive to interest rate movements because of their capital-intensive structures and dividend profiles. When rates rise sharply, utility valuations often compress. But as rate expectations stabilize and markets seek income with stability, utilities become attractive again. Their dividend yields, combined with earnings visibility, appeal to investors looking for balanced exposure. Additionally, many utilities have strengthened balance sheets and improved capital discipline in recent years. That financial stability enhances their appeal in uncertain markets. There is also an ESG component influencing capital flows. Energy transition goals remain a priority for many institutional investors. Utilities are central to renewable integration, grid decarbonization, and electrification initiatives. Companies investing in wind, solar, battery storage, and transmission modernization align with long-term sustainability frameworks. For funds with environmental mandates, utilities represent a practical pathway to support decarbonization while maintaining stable returns. This alignment between policy trends, infrastructure needs, and financial performance creates a compelling narrative. Another subtle shift is the reevaluation of what growth means. In previous cycles, growth was associated primarily with technology startups, high-margin software firms, and rapidly scaling consumer platforms. Today, growth is also being redefined as durable expansion tied to structural trends. Electricity demand growth linked to AI, manufacturing reshoring, and electrification is structural, not cyclical. It is multi-decade in nature. Utilities positioned to capture that growth offer long-term visibility, and long-term visibility is increasingly valuable. At the same time, other sectors face headwinds. Some technology segments are experiencing margin pressure. Consumer-facing industries are navigating uneven demand. Global trade uncertainties create volatility for exporters. Against that backdrop, utilities offer a simpler story: essential service, regulated returns, infrastructure-backed expansion, and increasing demand visibility. Markets often rotate based on relative confidence. When uncertainty rises elsewhere, sectors with clearer outlooks benefit. It is also important to recognize that utilities have evolved operationally. Many companies in the sector have embraced digital grid management, advanced analytics, and automation. They are modernizing operations while expanding capacity. The perception of utilities as static, slow-moving entities is outdated. Today's utility companies are managing complex networks, integrating renewable sources, and deploying smart grid technologies. That modernization supports efficiency and long-term resilience. All of these factors converge into one broader theme: stability plus structural growth. In volatile markets, stability alone is attractive, but stability combined with credible growth potential is even more powerful. Utility companies now sit in that rare position. They provide essential services. They operate within regulated frameworks that offer earnings visibility. They are central to national infrastructure priorities. They benefit from electrification and AI-driven demand growth, and they align with long-term sustainability trends. That combination has transformed investor perception. Utilities are no longer just defensive holdings tucked away for income. They are increasingly viewed as strategic enablers of the modern economy, and in a market searching for predictability, resilience, and durable expansion, that makes them something they haven't been in a long time. Market darlings.